Hello, friends. Welcome back to another of our Knowledge Club sessions. I am Devashish Ghoshal and I run a boutique investment bank called Invictus Corporate Solutions LLP. We are a team of practicing corporate finance professionals and would like to share with you our thoughts, ideas, and experience about various tools and techniques of financial analysis as we apply them in our real life assignments. Please visit us at invictus.co.in or reach us at info@invictusadvisors.net. In this session, we will discuss the aspect of valuation of intangibles and how these assets are linked to the economics of a business. The first question that we should ask ourselves is, what exactly are intangible assets? Intangible assets are those resources at the command of a business that have a monetary or economic value. In that, these assets contribute to the generation of economic surplus for the business, but are not present physically. Businesses have various types of intangible assets, and some of these intangible assets are unique to the business. However, on a theoretical plane, we can attempt at classifying three different kinds of intangibles based on the kind of competitive advantage a business derives from these assets. The first class of intangible assets are, in our theory, output descriptors. That is, intangible assets like the brand of a product or services, like McDonald's, Coca-Cola, HSBC, Citibank, etc., or the logo signifying the same. The second class of intangibles are assets that determine the quality or quantity of the output being marketed. Typically, input determinants would include assets like proprietary software, intellectual property, proprietary designs, copyrights, content, technical know-how, licenses, etc. These assets enable a business to manufacture and market such products or offer such services that command a value in the market. For example, the content library of an edutech company is an important intangible asset for its business. The proprietary software of a fintech firm that allows insurance or banking companies to assess retail credit is an intangible asset that is at the heart of the business of the firm. Automotive designs developed in-house are intangible assets of a car manufacturer. The third class of intangibles are assets that we call operating enablers, that is, factors that allow a business to function more efficiently and more cost effectively than otherwise would have been possible. Operating enablers would include customer lists, non-compete agreements, favorable financing, skilled human capital, etc. In general, the overall valuation of a business, i.e., the enterprise value, is expected to capture the value of all intangible assets of the business, since in the final analysis, the cash flows generated by the enterprise are a function of the cash flow generation capacity of all assets under its command. However, in many cases, we may need to transact, that is, buy, sell, or lease a single intangible asset, say a brand of an FMCG company, or the content library of an edutech company. And this is where we need to arrive at the valuation of the said intangible asset. Let's now quickly look at the key characteristics of an intangible asset. An intangible asset should be identifiable. It should not exist in the mind or imagination of its creator. It should have a name and underlying and legally tenable documentation establishing its existence. For example, proprietary intellectual property or IP relating to the traffic management system of a city will not be an intangible asset till the time the said IP is patented and the owner of the patent is clearly acknowledged by the licensing authorities. Intangible assets do not arise out of nowhere. They have to be created or purchased. And at any point in time, any particular intangible asset should have one or more owner. Hence, the asset under question should have some investment that's gone behind it, and the asset has to be owned or controlled by an identifiable entity. Intangible assets generally have a determinate life, unless we are talking about certain brands like Coca-Cola or McDonald's, or any catchword like just do it, etc. In most cases, the intangible asset has a useful life depending upon the nature of the asset. For example, a certain banking software can become obsolete within 2 years, but educational content may serve the business for up to 7 to 10 years. So each asset has to be treated differently. Finally, any intangible asset is just what it is called, that is, an asset, and therefore should be subject to free commercial transactions, that is, buying, selling, leasing, renting, and so on. Let's now look at the three major approaches to valuation of intangible assets. For accounting purposes, that is, for purposes of representing intangible assets in the books of accounts per Indian accounting standards, some guidelines have been prescribed by ICAI's valuation standard. However, apart from strictly accounting purposes, we may need to arrive at the valuation of an intangible asset if we want to buy it, sell it, or lease it, or rent it. Hence, in the real world, where actual transactions involve a brand or patent or IP, it is critical that we develop a qualitatively and quantitatively objective premise for the valuation of an intangible asset. The valuation standards prescribed by ICAI tell us that there are three basic methods to value an intangible asset. The first among them is the market approach. The market approach includes valuation methods based on an analysis of intangibles that are similar to the one under examination, for which data relating to recent transactions are available, that is, sales, purchase, or license agreements relating to a similar asset. This approach is based on the principles of supply and demand. For example, the amount received for the world rights of a film like RRR can be a benchmark for the valuation of another similar movie, or the value at which Coca-Cola recently acquired the remaining 85% of Body Armor, a sports drink manufacturer, could serve as a marker for calculating the valuation of a brand of a similar beverage company. But please remember, two things can queer the efficacy of the market approach. One, the degree of similarity of the asset we want to evaluate with the asset we want to compare it with. And two, the availability of relevant and reliable information about transactions involving similar assets. The second approach is the income approach. The income approach to valuing an intangible asset is to project the net earnings expected to be generated by the asset and then discounting them to a present value using an appropriate risk-weighted discounting rate. Now, while mathematically elegant, the income approach may involve significant degrees of subjectivity in areas of income and cost projections, as well as in the calculation of the discounting factor. However, in cases where income streams arising from an asset and associated costs are visible, transparent, and quantifiable, we can safely use the income approach to arrive at the valuation of the asset. For example, for trademarks that earn a fixed royalty, patents against which license fee is realizable, or any IP or content against which a future revenue stream can be assigned. The third approach prescribed by experts is the cost approach, which is based on the economic principle of substitution and does not factor in future economic benefits. Essentially, the cost approach wants us to estimate the cost of reproducing or replacing an intangible asset in the current market scenario. For example, if we were to assess the value of the movie Sholay as on the current date, we would need to factor in current market remuneration of actors, technicians, production and post-production expenses, and a whole range of other costs. Sholay's production cost was reportedly about 3 crores in 1975. A similar movie will probably cost upward of 200 crores today. However, the degree of obsolescence of an asset needs to be accurately factored in while using the cost approach to value the asset. For example, we need to ask ourselves, if we were to recreate Sholay today, would it have the same appeal or enjoy the same mass acceptance as it did 48 years back? If not, how do we factor in the obsolescence factor into the valuation model? Unfortunately, the cost approach doesn't give us a satisfactory answer. And finally, the cost approach is basically a static approach and ignores any economic value arising out of the asset in future. An asset that may have only taken $1 million to create, for example, a software, can potentially earn billions of dollars going forward. To appreciate this, you only have to look at the example of apps like Uber or WhatsApp. This brings us to the question, which valuation approach is the best for a particular intangible asset? The first thing we should look at while starting a valuation exercise is the objective of the exercise. That is it for purchasing an asset or selling or licensing an asset? Then again, are we on the buy side or the sell side? Or is it only for the purposes of compliance and reporting? The second principle that we should keep in mind is that each intangible asset is unique in itself, and the valuation methodology to be applied needs to be carefully considered in the light of the nature and characteristics of the asset under question. And finally, it is always advisable to use two or more approaches to value an asset in order to cross-check the results arising from various approaches, as well as to justify our final outcome. Hence, we can use the market approach for valuing assets like patents, brands, copyrights, etc., where we can find a readily available comparable benchmark, as well as recent transactions in that particular domain. The income approach comprises various methodologies, three of which are the royalty relief method, the multi-period excess earnings method, and the with and without method. The royalty relief method, or RRM, calculates value based on the hypothetical royalty payments that would be saved by owning the asset rather than licensing it. The rationale behind the RRM is fairly intuitive. Owning an intangible asset means the underlying entity doesn't have to pay for the privilege of deploying the asset. The RRM is often used to value domain names, trademarks, licensed computer software, and in-progress R&D that can be tied to a specific revenue stream and where data on royalty and license fees from other market transactions are available. The multi-period excess earnings method, or MPEEM, rather than focusing on the whole entity, the MPEEM isolates the cash flows that can be associated with a single intangible asset and measures fair value by discounting them to a present value. The MPEEM tends to be applied when one asset is the primary driver of a firm's value, and the related cash flows can be isolated from the firm's overall cash flows. Early stage enterprises and technology firms are prime candidates for this approach. The with and without method, or WWM. It is a method that estimates an intangible asset's value by calculating the difference between two discounted cash flow models. One that represents the status quo for the business enterprise with the asset in place, and another without it. The WWM is often used to value non-compete agreements. The cost approach is usually applied to value intangible assets to which a reliable future income stream is difficult to assign. For example, a movie or a software that hasn't been commercially launched yet. There are two methods to utilize the cost approach. The first is, of course, the historical cost method, where we simply add up all expenses incurred to create that asset. And the second is the replacement cost method, where we try to estimate the cost of reproducing a similar asset in the current market scenario. In our next session, we will describe the valuation methodologies discussed here in more detail. Till then, take care and stay tuned.